Most people are so focused on the working limits for 2026 that they are completely blind to five other massive shifts that are about to hit their bank accounts. While the working limits determine what you earn, these five changes determine what you actually keep. In 2026, we are seeing a rare combination of a higher than average COLA increase, a significant jump in Medicare premiums, and a brand new tax deduction passed in what's being called the One Big Beautiful Bill. That could save you up to $6,000. But there's a catch. One of these changes is actually speeding up the depletion of the Social Security Trust Fund by 6 months, and another is going to make it harder for future retirees to even qualify for benefits. Today, I am going to break down these five hidden updates with absolute clarity. We're going to look at the hard numbers, the income thresholds you must stay under to get the big tax breaks, and the net benefit formula that shows exactly how much your check will actually grow. If you want to master your retirement finances in 2026, this is the only guide you need. Let's dive in. The first big change is the cost of living adjustment, or COLA. For 2026, the SSA has set a 2.8% increase. Now, this is a significant step up from the 2.5% we saw in 2025. To put this into dollars, the average retired worker's benefit is estimated to rise by about $56 a month, moving from 2015 to 2071, starting in January 2026. If you are a married couple both receiving benefits, that average jump is about $88 a month, taking your combined total to $3,208. But here is the authority check you need to hear. According to an AARP survey, 77% of older adults say even a 3% COLA isn't enough to keep up with actual inflation. Why? Because the items seniors spend most on, healthcare and housing, often rise faster than the standard inflation index. This 2.8% isn't just for retirees. It applies across the board to survivor benefits. Average older spouse jumps to $1,919. Disability benefits, SSDI. And supplemental security income, SSI, where the maximum individual federal benefit hits $994. Pro tip: if you are on SSI, your first COLA boosted check actually arrives on December 31st, 2025, because January 1st is a holiday. Don't be surprised when that extra money hits early. It's not a mistake. It's your 2026 raise starting a day early. Now let's talk about the change that most politicians don't like to highlight. It's the Medicare Part B premium hike. The standard monthly premium is climbing from $185 to $202.90 in 2026. That is a 9.7% increase, nearly 4 times higher than the COLA percentage. For most of you, this premium is deducted directly from your Social Security check before it even hits your bank account. This creates what I call the net benefit trap. If your check goes up by $56 because of COLA, but your Medicare premium goes up by $17.90, your actual take-home raise is only $38.10. This is exactly why so many retirees feel like their checks aren't growing despite the headlines. It is critical that you review your Medicare Advantage or Part D plans during the enrollment periods. We've seen reports that over 1.2 million people could lose their specific coverage in 2026 as plans shift to handle these rising costs. If you don't look at your options, you might end up on a plan that costs you thousands more in out-of-pocket expenses, completely wiping out your COLA increase. This is the win for 2026. Congress passed a massive tax and spending bill, and within it is a provision that AARP and other senior advocates fought hard for. Starting in the 2026 tax year, eligible taxpayers age 65 and older can claim a new tax deduction of up to $6,000. This is specifically designed to reduce the tax torpedo, the phenomenon where your Social Security benefits become taxable as you earn more. Here is who qualifies for the full $6,000 deduction. Single filers, Modified Adjusted Gross Income, MAGI, up to $75,000. Married filing, jointly, combined, MAGI up to $150,000. If you earn more than that, don't worry. You can still get a partial deduction as long as your income is under $175,000 for singles or $250,000 for couples. This is a temporary deduction that runs through 2028. It is a massive opportunity to lower your tax bill, but it has a controversial side. Because this reduces the federal income taxes paid on benefits, it actually reduces the money flowing into the Social Security trust funds. The SSA's chief actuary warns this could hasten the fund's depletion by up to 6 months, moving the shortfall date from early 2033 to late 2032. It's a benefit today that creates a challenge for tomorrow. If you're over 65, make sure your tax preparer knows about the big, beautiful bill deduction. While change number 3 was about saving you taxes, change number 4 is about who pays into the system. Social Security is funded by a 12.4% tax on wages, split between you and your employer. However, the government doesn't tax every dollar you earn. There is a cap. In 2025, that cap was $176,100. In 2026, it is jumping to $184,500. This means if you are a high earner or self-employed, you will be paying Social Security taxes on an additional $8,400 of income that was previously tax-free. Why does this matter to the average person? It shows the SSA is trying to capture more revenue to keep the trust funds solvent. It also means that for those of you still in the workforce, your highest 35 years of earnings, which are used to calculate your future check, will now reflect these higher taxed amounts, potentially leading to a higher benefit down the road. The final change affects everyone still working toward retirement. To get Social Security, you need 40 credits, usually 10 years of work. You can earn up to 4 credits per year. In 2026, the price of a credit is going up. You will now need to earn $1,890 to bank 1 credit, which is an 80 increase from last year. To get your full 4 credits for the year, you must earn at least $7,560. If you are a part-time worker, a consultant, or someone just entering the workforce, you need to track this number closely. If you earn $7,500 instead of $7,560, you miss that 4th credit. Over time, missing these small benchmarks can delay your retirement by months or even years. This change tracks national wage trends, and it's a reminder that Social Security is constantly adjusting to the economy. If you find these updates helpful, please hit that like button. It tells the YouTube robots that retirees need to see this information. So, what is the 2026 survival plan? 1. Budget for the net. Don't plan your life around the $56 COLA increase alone. Subtract the $17.90 Medicare hike first. 2. Claim the deduction. If you are over 65, look for that $6,000 deduction on your tax return. It's real, it's legal, and it's yours. 3. Audit your coverage. With Medicare premiums rising and plans changing, 2026 is the year to be an active shopper for your health insurance. 4. Stay informed. The Social Security Administration is understaffed, and they often won't call you to tell you about these breaks. If you want to see the exact earnings limit numbers we discussed in our last video, including the first-year rule that lets you earn $1 million and still get a check, click this video right here. It's the perfect companion to what we talked about today. Thanks for spending time with me. I'll see you in the next one.